Welcome back, Smarties, to a special episode of Smart Real Estate with Westcliff, where we dive into different strategies to make you a smarter real estate investor. I'm your host, Addy Saeed, here with my co-host, Kaz Jaffer. So what we're doing today is basically a bit of a recap. So we have done 10 episodes, and these episodes are available for you to download and listen to. I just wanted to take a moment and pick on my co-host and to have a conversation with him about what his experience has been over the past 10 episodes. So Kaz, welcome to the episode.
Thanks a lot, Addy, and thanks a lot, Smarties, for tuning in and coming through here. 10 episodes strong. It's pretty exciting to be in the double digits. I hope everybody's been finding our content pretty valuable. I've definitely been enjoying the back and forth here with Addy and sharing our contrasting experiences. Good to be here with you today again to be able to catch up on our 10 episodes. It's a pretty big achievement for us as we move along. I hope our Smarties are really enjoying the content. But what I really love, one of the most interesting parts of what we were talking about really was around diversification. I think when we think about real estate, the way people would invest in real estate 20, maybe 30 years ago, traditionally it'd be in their own home. They might buy a condo. Now, more and more, we're seeing more emerging trends, a lot of limited partnership investment opportunities, scenarios where you can invest in real estate without actually directly owning or having to manage the real estate. And people with busy lives and families and lots of demands inside and outside of work, being able to still build wealth, get some access to real estate without having to do all the heavy lifting. One of the episodes I remember we were talking about the other day, I had one of my tenants needed a plumbing job done. I had to get on the little Jiffy app and figure all that out and do all that myself. Meanwhile, I've got 100 other things to do. So it's just really great to have access to something different, another way to be able to still invest in real estate without having to be active.
Yeah. You know what? It's been an interesting ride in the past 10 episodes that we have done. So what I wanted to do is I want to pick your brain a little bit and see how much you remember of the past 10 episodes that we have done.
Love being on the spot.
All right. The first one we did was Introduction to Real Estate Investment. I thought that was a really interesting episode we did where we went through different types of investments. What do you remember of it?
I remember there were definitely different types of real estate investments, whether you get into land, you get into residential, industrial, retail, just like anything else, there's flavors for anyone depending on what your risk tolerance is and what you're looking for in terms of returns.
Yeah. And then we also had talked about different types of investments that you can do, much like what you just discussed. The GPLP structure was one. You can invest in different funds where you, if you want to be hands off, if you want to be more hands on, you can purchase it in yourself or you can purchase it in a corporation. So ownership was a component of that too. Now, the best part is all of these episodes are bite sized. So if you don't remember any of it, you can always go back and watch or listen to the episode again. Then we talked about understanding the capital cycle. You remember? What do you remember about that episode?
Well, there's definitely capital involved, and there must have been some cycling. You're going to really have to juggle my memory on that one. I'm getting older than I used to be.
Yeah. Everybody's getting older. Then we talked about risk management in real estate, which I thought was a very interesting one. A lot of times investors don't think about the risk that is involved whenever they're making a purchase.
Yeah, on the risk side, it's interesting because you have the risk of the actual returns themselves, the income, the cash flow. Am I going to be able to exit this property? The other side of it is really just around the debt you take on. As you referenced earlier, the GPLP scenario, you're actually not taking on any debt. You're simply providing the equity as part of the deal versus if you were to buy a home yourself or a property, you're now signing for the mortgage. And so part of that discussion is where do you want to be in that cycle?
Yeah. And it's a very valid point because as an LP, it's limited partnership. You are not required to provide any guarantees. That's the GP, the general partner's responsibility to provide. They're taking your money and providing you with a return of that investment that you're making. This takes us to the next one, which was fundamentals of real estate development. You have a great experience and a lot of experience in this field. Do you remember talking about this? And what were your takeaways on that?
My only regret in that episode is we should have been wearing our hard hats. How can you do a development episode, hands-on guys like ourselves and not have
I
a
might
hard
have
hat?
it somewhere over here.
I know I have one in my office somewhere, but the kids got a real kick out of seeing the hat when we had those. But all joking aside, I think the development side, a big part is obviously site selection. The exciting thing about development is a lot of times you have that blank slate. You've got literally a piece of dirt and you're looking to understand, okay, what is the current zoning? What is it approved for today? And where is this community going to be going to transform to? And so you could look at this 3 or 4 years from now and all of a sudden drive by that building and say, hey, I was involved in helping that building come together and provide new housing for people and brand new building. And we talk about all the time. You see it in the news a lot about the shortage of housing and brand new real estate. Being able to put in smart and green strategies for the new housing is also important. So the development side, it obviously has its risks, but obviously a lot of different benefits that a traditional apartment may not be able to provide you.
Yeah, and then looking at it from a risk perspective as well, developers tend to be the riskiest of all of the investment types that you can do. There are more riskier like mining and all that stuff too, but we'll get into those. So next episode we did number 5 was financing your real estate investments. That was an interesting one, something right up your alley. You've been a CFO for different funds and that you've always had to work with lenders on helping them find money for their projects. What were your thoughts on that episode?
Sure. So financing very near and dear to my heart. I mean, the other near and dear to my heart is of course taxes when we get there. But from a financing standpoint, I think that's a critical area. It can really make or break your deal. And also looking at alternative financing, whether you're in Canada or the US, the government programs that are ever evolving and changing. So the Canada Mortgage Housing Corporation, or CMHC, has certain programs, different grants, different things like that, where the government and government entities are trying to incentivize housing or getting investing in housing. So it doesn't necessarily always have to be development. You could be taking an existing property and trying to find ways to add more units on to create more affordable and accessible and even as we call attainable housing for people. And then also the more, I'd say, less traditional ways of financing. I'm sure you're seeing it as well, but really the seller financing, or we call vendor takebacks. In my career, I have never heard or seen so many in the last couple of years. What's been your experience with those, Addy?
It's a very interesting point that you bring up because what we saw for multifamily, anytime a property was coming to market, one of the first questions I was asking, hey, does it have any existing debt on it? Because what we know is that if they signed a new debt, a long-term debt, especially a couple of years back, it would have been far below what the market debt is right now. So in some cases, some of these owners, they purchased properties and they had debt at 2%. I know when I was at Equiton, we got a couple at like 1.4. It
What?
was, yeah, it was pretty intense. Like some of the low rates that we were getting, it was pretty intense. And these are all CMHC insured debt. So in the marketplace, we're seeing properties where there's vendor financing being made available. And then we're seeing debts. Like if you have a debt on the property, pre-existing debt that is better than what it's available at the market, it's transacting at a better rate than what market properties are transacting at. A lot of times this vendor take back, it's actually more of a capital preservation strategy for a vendor as well, where they want to get a certain amount of dollar for their property, but they wouldn't be able to get it if they don't provide this option to the buyer, because at the end of the day, the buyer has to make money as well. So if they are able to provide a vendor take back option, they can preserve their capital. It's already invested. They can get some tax benefits from it too. So it becomes almost a win-win strategy for a lot of vendors in the marketplace. Stepping from there, let's chat about importance of location and timing. And then while we're at it, we also had episode 8, which was long-term versus short-term investments.
Well, you know how they say the location, location, location. So really, as an investor, you get to bring out your crystal ball and really try to look at what is that future going to look like for that area. When you want to invest, generally the investments that I've made, and I think we're very aligned on that, is I'm not only looking at where is the location today, what's available today, but what kind of what's happening tomorrow. And so there is a lot of information available to you, whether it's what developments are coming up in the area, what employers are in the area, how are things happening in that overall area. So when you do invest, you want to be part of something that can grow with you longer term. Or if you are in there for the short term, it'll be attractive for a buyer. I think that's the other side of it is thinking about your exit strategy, not just, okay, I'm going to hold it for long term because things can change. Your circumstances can also change in terms of what you're doing with your investments, how much heavily weighted you want to be in certain areas. So location, I think, is really critical when you're thinking about those things, as well as the long and short term strategy.
Yeah, same thing with timing as well. Understanding where you are in the capital cycle, understanding what the market is doing, what's happening in the market, what are the trends, demographics is very, very important. One of the things that I love is if you're working with a reputable real estate agent that has done their research, they usually will have an information memorandum that they make available. And this piece of paper will have so much information in there that will help investors make good decisions. But a lot of times, what I find is that either the agents don't put it together or the agents have put it together and the investors don't know how to read it or interpret the data that is there. You also have to understand that the data that is being presented is biased by the real estate agent in favor of the seller. So you have to take it with a grain of salt. So a lot of times, one of the things that I do when we're helping buyers out is we're actually going and double checking the information that is provided. Market rent is a prime example. Agents that are representing sellers are always very, very happy with the rents that they put out there. We actually go back and we do rental surveys on all the properties that we're buying. And the main reason for it is we want to double check the information that is being provided, if it's accurate or not accurate. Last but not least, episode 10 we did was about diversifying investment portfolio or creating a diversified investment portfolio. That was a really fun episode. It was a short one, but it had packed a lot of knowledge in there. I love the fact that we can offer our investors and investor community options such as GPLP investments. They can look at investing in funds. You can invest in real estate themselves. You can invest in different types of real estate. So you can invest in residential, commercial, industrial. You can go into multifamily. I'm keeping residential and multifamily different because I think of residential as your single family homes or your condos versus multifamily, which is still residential, but on a larger scale. I think 5 or more units. So having your hands in those many pots actually helps you diversify and create a very well balanced portfolio. And it minimizes your exposure to different market fundamentals that might be exposed to one segment of the market. And also location, to diversifying geographically, demographically, looking at different aspects of your current market and seeing how you can break it up so you can actually maximize your downside. So you might have a downside. If you have investments in office right now, you have a downside. Like office is not the sweetheart that it was a couple of years ago. So right now you might want to have some money in industrial, or have some money in multifamily, or if you're more long-term focused, have some money in development. Again, depends on how lazy or active you want your investment to be. So some very valid points we made, but again, we packed it really, really short. So all of our episodes are under 6 minutes and they're very easy listening for anybody that wants to go back and listen to them.
Yeah, for sure. On the point on diversification, I think the real estate, the private funds and things like that provide a lot of options there where you yourself may not be able to take down an entire property. And so having exposure to multiple properties across multiple different types of real estate really gives you that access across the board. Overall, I thought the series are good bite-sized episodes for most folks to consume. The idea being getting an overall, I'd say, general understanding of how real estate investing works and some of the aspects of it. And as you continue to listen, we hope to go deeper in some of these topics with you and of also many other real estate investment topics. I've been doing this for a long time and love the opportunity to be able to share with smarties like yourselves.
Yeah, that wraps up our discussion for today on doing a recap. Subscribe for more valuable insights at www.westcliffam.com/listen. Share your experiences in the comments below. You can find us, this and past episodes on our website. And if you can be of any assistance, feel free to reach out. You can reach us on the web at www.westcliffam, or you can call or text us at 647-799-2264.
Thanks, Addy. Our listeners are cautioned to consult with a financial advisor to tailor your investment strategies to your specific needs. This podcast is for informational purposes only.
Thank you guys, and we will talk to you in the next episode.